banks in recent years have had to invest more in their anti-money laundering controls. That's in response to new regulatory requirements. Now, many years ago, the definition of anti-money laundering was really defined to the detection of the proceeds of drug crime. But over the years, and particularly in the aftermath of 9/11, that scope has expanded quite considerably. So today, money laundering can include any serious offence. The Financial Action Task Force specifies activities such as serious tax crime to be predicate offences of money laundering. We see more and more countries adopting these FATF recommendations, and the consequence of that is that compliance departments within obligated institutions have a lot more work to do. There's more screening. Previously they may have only been screening for sanctions. Today those responsibilities have been extended to include looking for money laundering, maybe also anti-corruption, fraud, tax evasion, perhaps even reputation risk. So the range of subjects that need to be identified, assessed and monitored for risk has grown significantly over the years. And that's led to an expansion in the physical size of compliance departments. The financial system is very innovative, and innovations such as mobile payment technologies have really been transformational, particularly in emerging markets or developing markets where previously large sections of the population who were previously unbanked in a traditional sense can now participate in the financial system. It's a very flexible and adaptable technology. Providers of these services very often don't have a significant legacy technology base. The technology is quick to deploy and it's very nimble. Now that provides some really compelling competitive advantages. What we see is that these new technologies, these new methods of payments, peer-to-peer for example, mobile payments stored valued, they're increasingly becoming regulated and brought into the mainstream of the regulatory compliance framework. I think that's a good thing. It's not to add an additional layer of bureaucracy or to level the playing field. I know there's been a perception perhaps that because certain types of activities were less regulated, that they had some competitive advantages. But there is a need to ensure that terrorists aren't appropriating these technologies for their own ends. So we're seeing greater interest in making sure that innovation continues, that these services continue to be available to the people who really need them, particularly in poorer countries, but that there are controls and protections as well, so the criminals and terrorists don't misuse them for their own needs. Compliance costs have increased significantly in recent years, and that expenditure has gone on new systems, new technologies, more people, and more reporting tools. It's going to be difficult for that trend to be reversed today, in my view. There are more regulatory developments being prepared. The appreciation of the benefits of risk management has increased as well. So I think banks are increasingly seeing the business advantages of knowing their customers better, of having robust controls that protects their institution from regulatory action, from the disruption of having to remediate a regulatory issue, and that can suck up a tremendous amount of senior management time. It probably will involve a lot of unplanned expenditure. It may involve a regulatory fine, as well as probably bringing in some new consultants, implementing new policies, retraining staff, etc., etc. So the costs of a breach are more than the actual fine. It's all the work needed to resolve the problems to a satisfactory level, which is probably the most significant cost. In that context, spending money on technology or data to avoid a breach may be the more prudent approach. There is pressure, as there always is, for operational efficiencies. Customers are really trying to get more out of their technology. and data and their process to work more effectively. New technology has a role in that, particularly things like big data, analytics, various visualization technologies. There's a sense that with so much work to do, and the trend is always for more compliance work to be coming the way of banks. If the current status quo was to continue, it wouldn't be sustainable. We're seeing customers sort of reevaluating their approach to how they comply. They're reevaluating what they're really seeking to achieve. Are they just looking to tick the box so they can turn around and say, yep, we're compliant? Or are they really truly looking to understand their customers and the associated risks so that they can not only comply with their regulatory obligations, but also perhaps understand their customer better, understand their risk appetite, understand what their motivations might be, how that customer behaves. And ultimately, that's good business knowledge that could lead to more successful relationships. My guidance would start by asking a bank to consider how they're managing their different risks. So very often I still see different teams, different departments, different silos managing one single risk in isolation. Now, it may be the case that another team is doing something very similar in a different building. So, for example, having a fraud team, an anti-corruption team, maybe an inside trader or market abuse team, an anti-money laundering team, a sanctions team, working independently without collaboration, I think, leads to a lot of redundancy. So we're seeing that there's a tremendous amount of value in converging these processes together. Very often, the compliance needs for each of these disciplines is very similar, or indeed the same. It involves asking the same sorts of questions to customers. It involves monitoring transactions. It means understanding who your customer is, performing some due diligence, or perhaps some enhanced due diligence on a person or a company, looking to understand the beneficial ownership of a structure. In the light of the new guidance from the HKMA, if a customer has a very complex corporate structure, there's an expectation now that a bank needs to understand why that is. What is the economic rationale of a customer's structure? Why do they have several layers of shell companies in offshore jurisdictions? Why would they do that? We're seeing these sort of questions coming together now, and that's resulting in centralised KYC repositories that can be used for many purposes, not just one particular purpose such as anti-money laundering, but also for fraud, for anti-corruption, and so on.